those interest rates have been increased. Let's speak about what this essentially means for you and I. We're joined by Shiela Anne Robery, Liberty Financial Advisor, and later on the program we'll be speaking to an economist in terms of what is driving this monster of inflation in the country. Shiela, thank you very much for availing yourself this afternoon. I don't know about you, but not okay. How are you doing after this announcement?
I think it's not something that consumers should not have expected. I mean, we are aware that interest rates needed to adjust to pre-COVID and 2017 levels, but it still has an impact, and we know it. All of us that are consumers with home loans, credit cards, personal loans, vehicles, these type of decisions impact us, and they impact us on a daily basis, to the point where it comes down to rands and cents, where this will impact, the type of groceries we buy, the schools that our children attend. The impact is vast, necessary, but it is vast, and for the layperson, it's a challenging time, and this increase of interest rates has an impact.
Absolutely. Let's expand on the direct impact to the layperson, right? So, according to Statistics South Africa, let's bring up this graphic of the Consumer Price Index for October 2022. You take a look at some of the products that have become more expensive over the last year. Staples in the house, onions, laundry soap, cake flour, paraffin, washing powder, bread flour. Ice cream these days is a luxury, but those have gone up considerably, right? And the largest price changes between September and October. Again, staples that you will find in the house: onions, seasonal fruit, green, yellow, red pepper, biscuits, arguably a luxury these days, margarine spread, right, and peanut butter, which is something that you will find in many households. And so I guess essentially what does the everyday person need to do? Tips perhaps on how to make that rand stretch, if at all?
Well, just to put it into perspective for the listeners, if you've got a bond for R1 million, your repayment is going up by about 500 Rand a month, which is money that you can't be using to feed yourself and your family or other essentials. So certain things that are required from a consumer's point of view, again, is to severely be committed to your monthly budget. From the moment your salary or your commission comes in, to then allocate as strategically as you possibly can to the necessities. We need to really look at luxury purchases, and this, in view of the fact that tomorrow is Black Friday, I think a lot of South Africans are going to reconsider how they'll be spending tomorrow in light of this interest rate increase.
Isaah Mhlanga is the Executive Chief Economist at Alex Forbes, and he joins us now with Shiela Anne Robery. Isaah, no surprises here, but when you look at the current account balance being negative in the near term, according to the Reserve Bank Governor, and the revision of economic growth prospects globally and locally, that tells you that really we should have expected this, and the economy is not doing well, and we've known this for a long time.
Indeed, as far as economic growth is concerned, we see globally lower growth, but also locally, as the SARB has presented its forecasts, much lower growth. But I think the big issue for the SARB, which lies within their mandate, is fighting inflation. And yesterday's numbers surprised on the upside, both headline and core inflation, which would have changed somewhat the trajectory of monetary policy. But I think with a 7% repo rate that we have currently, equivalent to the steady state or the neutral rate, this is potentially it, unless if inflation surprises on the upside relative to these current forecasts. In our view, this is the peak, but if inflation increases beyond where the SARB forecast is over the medium term, then we might see an additional 25 basis point of an insurance hike in January.
Isaah, let's talk about something else that's happening in a couple of days, and that's the third quarter quarterly labor force survey, unemployment numbers. When you look at all this economic data that's coming out, CPI yesterday, how the manufacturing is doing, how mining is doing, interest rates are higher, and inflation is now sitting at 7.6%. How do you think this is going to influence, or this is going to play out in terms of your expectations when Stats SA announced on Tuesday the unemployment numbers, because we're trying to deal with unemployment right now?
Look, interest rate decisions are forward-looking, while unemployment statistics are backward-looking, which means they tell us what's already happened in the economy. We therefore think that given the extensive load shedding that we have seen, we are not going to see a significant improvement as far as job growth is concerned. More likely, the unemployment rate will have risen rather than moderated. But going forward, given the expectation of a lower economic growth next year, it means even less prospects of job creation and therefore higher probability of experiencing an increasing unemployment rate. Both from a global perspective, demand is weak, but also from the cumulative effect of the interest rate increases that we have seen. Remember, monetary policy works with a lag of up to 18 to 24 months, which means all the cumulative interest rates that we have seen to date are going to be felt over the coming months. They have not yet filtered through, and that is going to impact on the borrowing costs of corporates, and therefore also their decision to either increase or reduce headcount in their operations.
Shiela Anne Robery is a Liberty financial advisor. Shiela, the Reserve Bank governor mentioned something. He said that the average salary growth has remained broadly unchanged. So a two-pronged question maybe for your debt and for your investments, if you have, right? So is it too late to fix your repayment terms with your lender? And also, how do you safeguard your investments against the volatile interest rates?
Just in terms of opting for fixed interest rates on debt, it's not something that I would necessarily advise for clients. It may be too late, but that would depend on the financial service provider in question. But, just in terms of how, interest rates did come down as a result of the COVID-19 pandemic, which is not something that we really foresaw, to opt into a fixed interest rate will sort of result in a much higher repayment structure in any event, which won't necessarily create more cash flow or spending or, promote spending. So a fixed interest rate is not really something that is going to assist a consumer in these times. With regards to volatile interest rates in terms of investments, now is ideally the time where clients should be reaching out to a financial advisor to just ensure that their portfolios are in line with their expectations. Equity-heavy portfolio is something that should be considered over a much longer term. In these volatile times, it's important for clients to remember to remain level-headed, and such things are supported through the assistance of trusted financial advisors. We can experience volatility over the short term, but not to act on it in the short term is probably the best approach to take.
Isaiah, we can't talk about this enough. Every week, or every day we are living in it, although Eskom has just lowered that load shedding stage to stage 3 this afternoon. The Reserve Bank MP saying that the fourth quarter growth is forecast to be only 0.1%, largely due to record load shedding. We are expected load shedding to also eat into growth for the entire year. This is an own goal that we have scored, and we don't seem to have moved an inch to make sure that we have a reliable energy supply.
Indeed, if you look at the SARB's forecast for growth over the next 3 years to 2025, they are all below 1.5%, which means they have taken into account the binding energy constraint that we have following information that came from Eskom directly that told us over the next 2 years we will still have load shedding in various stages as we currently experience. So even in the event that the global economy picks up, we still have that binding constraint. But unfortunately, the expectations for the external environment is one for lower economic growth, and as a result, the factor that made South Africa to grow over the last 2 years, which is commodity prices, are going to moderate, which means one of those factors that really helped us is no longer there to help, in addition to our own self-inflicted pain of insufficient electricity. So we can talk about all the investment drive as much as we want until we have enough energy security in the country. It's not going to materialize. It's simply not plausible to expect private sector investment from offshore investors when we cannot guarantee them energy security. Even in the domestic instance, it's just not plausible. So energy, a binding constraint that will continue to drag economic growth lower, and as a result, the high unemployment rate will remain up until we have resolved it.
Let's talk about something else, Isaiah, that he mentioned, and that is the weaker export developments. And that talks to what is happening with Transnet, the troubles that they have been having of late, including the fact that their train lines, their exports are simply not helping the commodities sector. The current account balance expected to be negative until 2025. This does not bode well for the economy, of course.
Indeed, Transnet's issues are, water under the bridge, because when commodity prices were performing better, we did not capitalize in terms of making sure that we ship those high volumes of commodities because of those constraints. Going forward, we will have lower exports, not just because of Transnet's issues, but because global growth is moderating. 3 of the major trading blocs, the UK, Europe, the US, we could add China as well, will be experiencing marginal economic growth next year, which means they are not going to be demanding as high commodities that we export as they used to be over the last 2 years. And that implies our export growth is going to be weak. And added to that, if we continue to have constraints as far as Transnet's ability to ship whatever commodities we can, then that is going to add even more pressure to the growth in exports, which means there are downside risks to growth where we are. So we might actually end up with a much lower growth next year than what is currently being forecast, if growth continues to moderate globally, but also if Transnet fails to reopen a lot of its railway lines to ship the commodities that we'll be producing.
Shiela Anne Robery, a final question to you, perhaps for the everyday consumer, right? So if you do have debt that you are servicing and you know you will not be able to meet that debt or service that debt, how important is it that you speak to the lender, right, to make payment arrangements so you avoid this negative cycle of debt?
Yeah, Dudu, I think it's incredibly important to keep those lines of communication open. It's so easily to, let emotions get the better of you and to shy away from this overwhelming mountain of debt. But once the lines of communication remain open, there are certain payment arrangements that can be made. It's very important for consumers to remain as frugal as possible in their spending habits, and to reach out to financial advisors to restructure their budget, to offer those tips when it comes to grocery spend, when it comes to debt restructuring, when it comes to how to negotiate with financial services providers. All of those things can be attended to. And it's just about offering the consumer support, because it's an incredibly emotionally overwhelming experience every time SARB increases the interest rates.
A big thank you to both our guests, Shiela Anne Robery, Liberty Financial Advisor, and Isaah Mhlanga, Alex Forbes Executive Chief Economist, and of course our very own Mr. Xolani Mbanja, sir, our business editor. We'll continue to reflect on the latest decision to hike interest rates by 75 basis points.